tonight we are going to cover discounted cash flow analysis. And if you're a new trader or if you are an experienced trader, it doesn't really matter. We're going to go through the basics of it and we'll walk through it step by step. So I'm going to be bouncing back and forth between this template that I created and the slideshow. So I'm not going to go into, presentation mode tonight, but we'll click back and forth between these as we go through the presentation. And then also when I'm done, I will also share the slides and I'll also share the template with everybody, and that'll be in the archived streams channel. So, okay, just some quick housekeeping things. If you are in Discord and you have a question, you can type /question followed by "this is my question," something like that. And you see the little green check mark there that showed up. That will go directly into the questions channel, and then I can come back to that and see all the questions at the end of the night. So if you have questions along the way, feel free to do that, and I will get to them when we're done. All right, so let's talk a little bit about links to the template on the Discord. Yeah, you know what? I'll actually just, it's not shared right now, but I'll just throw the link into the Twitch chat as well. And let me just share this real quick. I'm going to take this off my screen temporarily just because I don't know what's going to pop up when I click share. So give me a moment here. In the meantime, you can look at my beautiful coffee and flower desktop background. Okay, so change to anyone with the link. Done. And then we'll also share this. Change to anyone with the link. And I'll copy that. All right, so that's that. And I'll put that in the Twitch stream. And I'm going to throw these. Is this in Wall Street Bets the same thing? Yeah, totally. All right, so there's that. And I'm going to copy this. So there's the template for anyone who wants to follow along. And then here is the slideshow. All right. So, discounted cash flow analysis. So let's talk a little bit about the audience for this talk tonight. We are aiming tonight at long-term investors making investments intended to last more than 5 years. So this is not for day traders or short-term swing traders. This process of discounted cash flow analysis is aimed at people who are making long-term investments. And the reason that I say more than 5 years is because usually when you do a discounted cash flow analysis, the minimum amount of time that you want to do is projecting out 5 years. Cool. Thump. First of all, love your username. And second, thank you for coming. Long-term trader. Good to hear. So hopefully this will be helpful. Also, value investors will find this useful for finding undervalued stocks. So I know some of you guys are probably here from Reddit's undervalued subreddit, which, by the way, is awesome. If you're not a member of that, it just popped up recently, but it's growing really fast. So it's reddit.com/r/undervalued. And they have everything like really organized, and they post theses for undervalued stocks all the time. So it's been really cool. So I've been following along with that. So for those who are here from that, you will hopefully find this useful as well. Short-term traders, that's me. I'm a shorter term trader primarily. I don't really do a ton of long-term investing other than 401k and IRA stuff. But short-term traders, I think, will find this useful, at least in determining the impact of short-term news. So when a stock takes off 200% in one day, right, it's good to know whether it's actually worth anything. And lastly, just that I want to always cover that this is not a recommendation to buy or sell anything. I'm not a financial advisor. I'm just some guy on the internet. So, do your own research and due diligence before you buy anything. So let's talk about what is cash flow. So cash flow, if you're not familiar with how to do fundamental analysis, is just a measure of the amount of cash that's either generated by or used in operating a business. So it's literal cash coming in and out of a business. And when conducting discounted cash flow, analysis, what we do is we use what's called free cash flow, which is considered to be the true cash available to all stakeholders in a company. So it takes into account depreciation. Well, it excludes depreciation and stuff that is non-cash expenses. So basically with free cash flow, that is what would be available to you as an equity investor and not like a bond holder or a debt holder. And the formula for free cash flow, there's a few different ones, but the simplest one is operating cash flow minus capital expenditures. And you can find that information on the company's financial statements. So we'll look at that as well. So just to give you an example, we're going to use Apple tonight because it has quality data, and also it's an easy company to value. So we'll use that as an example. And in order to find its free cash flow, I'm going to try to stick with, free stuff for the most part. So let's go to finance.yahoo.com. And if you just throw in Apple and then click on financials, all of their financial statements are here. So they actually, Yahoo Finance has come a long way. In the past, it used to be like really buggy and their data was all wonky and, it just wasn't organized, but they've really, they've cleaned it up a lot. So this is a great resource if you are looking for something free. So they even calculate free cash flow for you right here at the bottom. And they do it the simple way, just using operating cash flow minus capital expenditures. And why am I looking at BEP all of a sudden? This happened earlier also. I think I typed and hit enter too fast, but I typed in Apple and I ended up looking at Spotify somehow. But anyway, so here is Apple's financials. And if we look at cash flow, free cash flow here at the bottom, you'll see cash flows from operating activities at the top. That's the first part of it. So operating cash flow of $69.391 billion. That is right here for 2019. And then capital expenditures here is $10.495 billion as of 2019. We're not going to use trailing 12-month data. We want to use annual data just because that's sort of point in time. And you always want to use, at least for this type of analysis, you want to use annual data. And I think that you can do discounted cash flow with quarterly data as well. But I usually just do it with annual data because I'm projecting out, 4 or 5 years in the future. So anyway, this is where that information comes from. So if you look on the presentation here, CapEx of $10.495 billion, and then to get free cash flow, you just subtract it. So that's real simple. And that's sort of where everything starts, is this $58.896 billion in free cash flow. By the way, I should preface this by saying that I am not a financial valuation expert by any means. So if I make mistakes in this, please call me out on it and tell me that there's a better way to do this, because I'm relatively new at valuing companies this way. So if you know of a better way, or if I'm doing anything wrong, please point that out so that we can all learn from it. And the other thing I want to point out here is just that you might see different types of calculations for this, because there's two different kinds of free cash flow. There's free cash flow to the firm, which would include cash that's available to bond holders and debt holders. And then there's free cash flow to equity, which is what we're going to be using. And that is supposed to be the cash that's available to equity holders. And that's you, for those who don't know what that means. Stockholders. All right, so there are three components. Well, there's a bunch of different components of free cash flow, of discounted cash flow, but the main ones are free cash flow, which we've talked about, and then the intrinsic value of the business, which is the dollar value of the business, and then shares outstanding. And in order to determine the intrinsic value of the stock, or the price per share, all you really need to do is figure out what the business is worth in terms of dollars, and then divide it by shares outstanding. That's what we want. So this piece right here is the ultimate goal. That's what we're trying to get to, is the intrinsic value of the stock. All right. So in order to calculate that, this formula here might look complex, but it's actually really not. So the intrinsic value of the business is the sum of all of its projected future cash flows. So this FCFE is free cash flow to equity, and this 1 means the first year. So we're right now in 2020. So the first full year of free cash flow is going to be 2020. So that's the first year that we're projecting because we don't have the 2020 annual data yet. And then the second one would be, 2021, and then 2022 and 2023 and so on out to N, which in our case is going to be 5 because we're going to project 5 years out into the future. So we'll project out into 2024. And some people like to project more than that, but it just becomes increasingly inaccurate as you go further and further out, just because it's difficult, right, to predict what a company might look like in 7 or 8 years. It's pretty easy to predict what they might look like next year. But when you get out into 5, 6, 7, or 10 years, it becomes harder and harder to really be accurate with your predictions. So some definitions here. Free cash flow to equity, we talked about. R in this case, the 1 plus R to the 1 and 1 plus R to the 2. R is the discount rate or the weighted average cost of capital. So this is effectively the return that you expect from your investment. So if you were making an investment, this is the return on investment that you would expect back in order to determine whether or not it's worth it to spend the money on it right now. N is the final year of your projection. So in our case, N will be 5. And then terminal value is similar to these other values for free cash flow. But in this case, we're going to take 1 plus the terminal growth rate, and then we'll also look at the market rate minus the risk-free rate. So we'll go into more detail about how to calculate that in the future slides. So G is the terminal growth rate. That's the growth rate that we expect the business to grow on past period N. So if you think, for example, that Apple is going to grow for the next 5 years at 6.5% each year, then the terminal growth rate might be from year 2024 onwards. We really don't know. So we're going to project that it'll grow at, say, 2.5% for the rest of the life of the company. So that's what the terminal growth rate is. And then in order to figure out what the intrinsic value of the stock is, we're just going to divide the intrinsic value of the business by shares outstanding. So that's what this whole thing is trying to get to, is we're trying to figure out what the dollar amount of the business is. And then we will take that and divide it by shares outstanding in order to get share price. So we're going to break this down into 7 different steps. And the 7 different steps will help us get to this ultimate goal of predicting the stock price or forecasting what the stock should be worth today. So the first one is to project revenue. And in order to do that, we are going to go through a few different steps. So just at a high level, this is the process that we're going to take. First, we will project revenue, and then we'll project net income, and I'll show you how to do that. And then we'll use both of those things in order to project free cash flow in the future, because what we want, right, is the sum of all of the company's future expected cash flows. 1 second. I just want to double check something here. Okay, cool. For some reason, I just got like a really paranoid feeling that I hadn't clicked the record button, even though I'm confident that I said that out loud, and I just forgot. So anyway, what we want to do is sum up all the total future projected cash flows. So we need to project that out 5 years into the future. Then we're going to calculate our required return, which is WACC, also known as the weighted average cost of capital. Then we will project calculate the terminal value of the company. So that's the value of the company from period N all the way until the end of time. And then we will use all of that stuff in order to calculate the present value of free cash flow and thus the intrinsic values of both the business and the stock. So if this seems too opaque right now, we're about to get into the nitty-gritty details, which is pretty simple. So step one, projecting revenue. The first thing that we need to do is collect all of the historical free cash flow. So you can do this on Yahoo Finance or just by looking at the financial statements. And it's really simple here because Yahoo Finance breaks it down for you. So we're going to start with 2016. And just remember, by the way, that for whatever reason, they put the most recent year on the left. So if you're just copying and pasting, make sure that you have your years going in the right direction or everything will be all kinds of messed up. So this is what we want, right? Are these values right here. So what I did was in this template on step one, where we're projecting revenue, I copied in the operating cash flow. So that comes from cash flows from operating activities right here. So 65.824 billion, 63.598. That's what these values are. So there's 65824, 65398, and so on out to 2019. And what we're going to do, by the way, is I broke this into sheets. Ultimately, what you'll need in order to do this yourself is just the final step, because that has the entire calculation on it. But I wanted to go through it step by step and highlight each part along the way. So I copied in OCF, and then I also copied in CapEx, and then these are, just the simplistic calculation of operating cash flow minus capital expenditures, and that gives us free cash flow. So that is part one here. Next, we need to calculate the historical ratio of free cash flow to net income. And the reason that we want that is because it's going to allow us to project net income in the future, which we will need. So that is really simple to get also. If you look at the income statement and then pull in net income from 2016 until 2019, and that's right here. And then all I had to do is just divide net income by, divide free cash flow by net income. So what I'm trying to do is figure out, what percentage of free cash flow ends up as net income. And ideally, in order for a free cash flow, discounted cash flow valuation to work well, at least using this method. Now, there's other methods to calculate, to project net income and so on, but you generally want to see this free cash flow to net income ratio be around 100%, because that means that their free cash flow generally is representative of their net income. So they are in line with profits. So we can rely on free cash flow as a measure for, how well they will do in terms of profits. So we want to see this around 100% if we can. If you start seeing this free cash flow ratio, bouncing around to 400% or minus 200%, or it's just like really all over the place, then you might need to come up with your own estimates. But this is just a good way to get you started. So what I do is take all of these values and average them together. And that's what we end up with in cell E9. And that gives us an average free cash flow to net income ratio of 108.53%. So on average, free cash flow is about 108.53% of net income. So did I do that right? Or is it the other way around? Free cash flow, what's this formula here? So B6 divided by B7. 114, whoops. Yes, so free cash flow is about 114% of net income. Okay, so we have the average, and all I'm going to do is just project that out and use that as my guide. Now, remember that we're trying to project revenue here. So in order to do that, what we're going to do is calculate historical revenue growth, which is really easy to do, right? You just pull in all the revenues year by year, and then you calculate the growth rate from 2016 to 2017, and then drag your formula over. And this is just, current year minus previous year divided by previous year. So just a standard calculation for revenue growth. And then as far as this average, I've just averaged these all together. You could also use CAGR for this, but I, for this example, just used the average revenue growth because I'm just looking for a basic estimate. The other thing that I did here is I included in this average revenue growth the first two estimates from Yahoo Finance. So for 2020 and 2021, that's where these numbers are coming from, this 1.3 and 12.3. If you look on the analysis tab here, right here. So current year, there's 35 analysts that are projecting that we will see 1.3% sales growth year over year, and then 12.3% in 2021. So that's where those two numbers are coming from. So what I did was to get a projection of like roughly where revenues might go, just average these all together and then fill in the rest with that. So that means that we now have projected revenue and step one is complete. So in the next step, we're going to see what the reason for this 108.53 is. And that is for projecting net income. So let's move on to the second tab here. So there's a few different ways to calculate net income. The easiest way for Apple, at least that I found, was to figure out what their historical net margins looked like, and then assume that we're going to return, as long as they're consistent, assume that net margin is going to stay roughly the same into the future. They're pretty consistent around 21 to 23% roughly. So, this might change, but this is sort of the art of discounted cash flow analysis, is like making these projections. It's not really a science, it's an art. So right now, I'm just going to assume that we average all these net margins together and project that out into the future. And that's going to allow me to calculate, right now that I have projected revenues, all I need to do is take those revenues, calculate 21.47%, and now I have my projected net income. So this gives us a way to easily project net income as well. So that step is pretty straightforward and pretty simple. By the way, if you don't know how to calculate net margin, it's real simple. It's just net income divided by revenue. So that's how that 21.19% is calculated. So hopefully that's clear so far. So we calculate the historical net margins, and then we use the revenues that we projected in the last step in order to, in conjunction with those margins, in order to calculate the future net income. And now we can use net income and that free cash flow to net income ratio that we calculated earlier in order to derive our projected free cash flow. And that is what we're really interested in, because that gives us the first part of this intrinsic value calculation. That gives us all the FCFEs. So we have the top pretty much done at this point once we project out free cash flow. So if we move on to the next tab, remember that we have this 108.53. We now have our revenues projected. We have our estimated net margins going into 2024. Then we also have our projected net incomes based off of those margins. And we also have the free cash flow to net income ratio, which gives us the ability now to project free cash flow by simply multiplying 56.575 times 108%, and we get 61.4 billion. And we're just going to do that for each individual year as we go out. So this gives us our projected free cash flow. So that's sort of the top half of all of these equations. And yeah, I see a question in the Discord right now. Which company are we analyzing? We're looking at Apple right now. Okay, so where were we here? Step 3. All right, so if you have any questions on steps 1 through 3 there, throw them into the questions channel and we'll get to them at the end. But hopefully that's straightforward so far. Step 4 is where it gets a little scary, but I'm going to take you through this step by step so it's not as bad as it looks. So remember that we needed, as one of the components of free cash flow or of discounted cash flow, we needed the intrinsic value of the business. And in order to calculate that, we need this discount rate, right? So this is going to give us the R in all of these equations. So in each individual projection for each year, this is going to give us the R. So that's what we're calculating here in step 4. Now, to calculate WACC, there are 4 different components. We have the weight of debt, so the relationship between debt and market cap, the rate of their debt, right? So the interest expense that they have in order to hold that debt. Then we have the weight of equity, in other words, the other however much percent, right? The weight of debt plus the weight of equity is the 100% of the company. And then we have the cost of equity. And then this T in the middle here, that's the effective tax rate. So my process for this was to basically break down each one of these things into its individual parts. So on step 4, I've introduced this section over here where we will calculate the weight of debt, the effective tax rate, the cost of equity, the cost of debt, and the equity weight, and then we'll use all of that to calculate WACC. So all of this comes from information that we already have, which is nice. So we'll just go through it step by step. So first things first, calculating the weight of the debt, in other words, how much debt they have in relation to their entire market cap, is a simple calculation. It's debt divided by the total of their current market cap plus all of their short-term and long-term debt. So the entire value of the company, right, is the value of the stock price, right, so market cap, plus all of their debt. So that's the whole weight of the entire company. So in order to calculate that, we need those few components. We need market cap, we need short-term and long-term debt, and again, all of those can come from the financial statements except for market cap. And I'll show you how to get market cap also, which is pretty simple. So in order to get debt, we go to the balance sheet, we go to liabilities, and then there's 2 components. There's current liabilities and non-current. So current is stuff that's due within 1 year, and non-current is longer than a year. So this is long-term debt, and then current debt or short-term debt. And some companies will just report total debt. They don't break it up into current versus long-term, but what we want is the total of 91.807 billion plus 16,240. And in order to make it simple and to show how this is calculated, I broke those into individual pieces here. I know that the total debt is just 108 billion, but just to show how it's calculated, we bring in both short-term and long-term, just add them together. So that's total debt. So then we need the market cap so that we can calculate the weight of that debt. And the market cap is real simple. I just pull in the current stock price from Google Finance, and then shares outstanding is coming from their 10K. Actually, it's coming from their 10Q. This is one of the only things that you want to use the 10Q for, unless the 10K is the latest one, but I'll show you why here. So if we look at sec.gov and we pull up Apple's most recent filings and we type in 10 dash, and by the way, there is another video on this, how to read a 10K report. So if this is not familiar to you, then go and check out that video. We went through all of this. So you can see, right, they released their 10K in 2019. So this is the document, from October of 2019. This is the document that all of these numbers are coming from, the 2019 column here. But they've released a couple more quarterly reports since then. So what I want to do is get the shares outstanding from the quarterly report because it's the most recent. But we don't want the financials from the quarterly report because that's going to give us only quarterly financials, whereas the 10K gives us the whole year. So since we're projecting annual revenues and annual free cash flow, we want to use the whole year data. We don't just want the 10Q data. But for shares, we want the most recent one. So to get it, you just open up this first link here, and it'll usually be like right on the home page, or the main page, like on the front of the 10Q report. So this is it right here, 4334. So there's 4.33 billion shares outstanding. So that's where this came from. So the 4334. All of these are in millions, by the way. So multiply all these numbers by a million. And that'll give you the proper values. So with those two things, we can easily calculate market cap by just multiplying them together. And that gives us about a $1.51 trillion market cap right now, if I'm reading that correctly. And then in order to calculate the weight of debt, we're just going to take total debt plus market cap. So all of that divided by total debt, as it's debt divided by the market cap plus total debt. So that's going to give us the weight of debt, which is what percentage of the market cap is, what percentage of the company's total value is made up of debt. And in this case, it's just over 6.5%. Okay, so that gives us the first part of WACC. That takes care of the weight of debt. The next thing is the cost of that debt. So we want to know how much it's costing them to hold that debt. And we can get that by looking at their interest expense, because that's the interest that they're going to pay on all of their debt. But the thing is, interest is usually tax deductible. So debt on interest is usually tax deductible. So that's why we want to multiply it by the 1 minus the tax rate. And that brings in another formula here to calculate the effective tax rate. So we'll talk about each of those in sequence. So first things first, interest expense and total debt, both of those things just come from the financial statements. So total debt we already have. That's 108 billion, which we just calculated. And then interest expense is right here. And then, by the way, for these values, right, where we're calculating the current WACC, or the current weighted average cost of capital, we want to use the most recent, up-to-date data. So that's why I'm using the 2019 values. There's no projections in this part. We're just taking the latest data that we have. Okay, so that gives us, when we take 3576 divided by 108.047, that would give us 3576 divided by 108.047. That gives us about a 3.3% cost of debt. But remember, then we have to multiply it by the effective tax rate in order to account for that tax deduction that they will get. So that's the next part of this. We look at the tax expense, which is right here. So 10.481 billion. That goes in this cell. And then we want to divide that into earnings before interest and taxes. So we want to figure out what their tax was that they paid on all of their earnings. And in this case, it works out to about 16%. So then we take the interest divided by total debt times 1 minus the 16%, and we end up with the tax-adjusted cost of debt, which is 2.78%. So now we have two components. The third component is the cost of equity. Oh, and by the way, the weight of equity is really simple. Because we know the weight of debt, then we just subtract that from 1 in order to get the weight of equity. So these two together should add up to 100%. So that part's real easy. Okay. Now, in order to get the last piece, the cost of equity, we're going to use something called CAPM, which is the capital asset pricing model. And this uses 3 different components. It uses the risk-free rate, which is the interest rate that you would expect to earn on something that has no risk. And that would be like a savings account, or like a 10-year or like a 30-year treasury bond, something with very, very little risk. And this is, again, another piece of the art of discounted cash flow, is that, this stuff is all subjective. You can decide for yourself what you think these should be. But generally speaking, your risk-free rate, would be pretty low, like 1.5% or something like that. And then the market rate is what you can expect to earn in the market at large. So usually this would be something like an average of like the last 10 or 20 years of the S&P 500 returns. So for this, I usually use something like 7% or 7.5% just to be conservative. If you want to be more aggressive, then you would put the risk-free rate higher and the market rate a little bit higher. And then the last component it uses is beta, which is a measure of volatility with respect to the market, and that can also be found on Yahoo Finance if you just go into the statistics. And it's right here at the top. So they calculate the 5-year monthly beta as 1.17. And don't ask me how that's actually calculated, I don't know, but that's what we want to use. So that gives us, altogether, gives us our cost of equity. We have the equity weight, cost of debt, the weight of the debt, and the effective tax rate. So we have all of the things that we need now in order to calculate WACC, and that's what this cell is giving us. So now going all the way back to the beginning, we now have R. So in our case, R is going to be 8.14%. That's our required rate of return. What else do we need moving forward? So that's step 4. Step 5 is, so we now have enough, right, to calculate all of these. So we can calculate free cash flow 1, 2, out to 5, and we have the proper rates. So we have everything except for the terminal value of the company right now. And that's what we're going to calculate in step 5, and then we'll get to calculating the intrinsic value. So to calculate terminal value, what we want is the last period of free cash flow. So we are going to look at our projected free cash flow and take, moving on to step 5 here, just adds in this little cell over here. What we're going to do is take the last year of our projected free cash flow, and we're going to come up with a growth rate that we can expect Apple to grow at for the rest of its lifetime, realistically. And so if we just assume like the growth rate of the US economy or the world economy or something like that, it's probably going to be something like 1 or 2%. So a good way to do this would be to use like a 2.5% or a 2% perpetual growth rate. This can be more aggressive if you want to have a more aggressive valuation, but usually, if you're a more conservative person, you want to keep this perpetual growth rate pretty low, because right, if you say that Apple's perpetual growth rate is going to be 10%, you're basically saying that Apple is going to become more valuable than the entire world economy, right? Which is probably unrealistic, but that's what we're calculating here is the terminal growth rate. So in order to do that, all we do is take our required rate of return, which we just calculated in the last step, so our R, and we need the perpetual growth rate, which is arbitrary, so we're just picking one for this, and that's part of the art of doing this, and then we need our final projected free cash flow. So the formula for it is free cash flow to equity of the last year times 1 plus the perpetual growth rate, so 1.025 in our situation here, and then we want to subtract the growth rate from the required rate of return. And that is going to be, scratch that. I should actually specify here, the terminal value is going to be, where is it? Our required rate of return, or do we want the market rate here actually? Give me just a minute. I want to verify that this is correct. No, we do want our weighted average cost of capital minus the perpetual growth rate. So when we calculate that, we end up with a terminal value of $1.52 trillion roughly. So that's the value of Apple projected out into the rest of its lifetime. So now that we have all of the components we need in order to calculate the intrinsic value of the business, the rest of this is easy. So we have free cash flow 1, 2, 3, 4, and 5. We have our required rate of return. We now have the terminal value. And that's it. That's all we need in order to calculate the intrinsic value of the business. So moving on to step 6, what we're going to do is, well, we're going to use this in the next step. But before we get to that, we need to calculate the present value of all of these cash flows, right? Because we need to discount them back to today. So that is step 6. We need to calculate the present value of all of these free cash flows. And in order to do that, we're going to use our weighted average cost of capital in order to come up with the discount factors. So if you think about this simplistically, if we were going to have a constant growth rate of, say, 8%, then in order to figure out the value of $61.4 billion today, we need to discount it by 8% because that's what we expect to earn each year. So that's why this present value of free cash flow calculation here is 1.0814. We want to divide the projected cash flow by our discount rate, which is just 1 plus the terminal value here raised to whatever period you are in. So in this case, it's just raised to the 1. And that's going to give us the present value of our free cash flow. And another way to look at this is, right, if you take 56.78 billion and you multiply it by 1.0814, you're going to get that 61.4 billion. And we do that for each individual one. So looking back at that formula, which is somewhere here. 1 plus r to the 1, 1 plus r to the 2, 1 plus r to the 3, and so on and so forth. That's what these values are. So this is 1 plus r to the 1. That's 1 plus r to the 2. And you can see I'm just multiplying it by the projection period up here. So to the 3, 4, and 5. And then the present value of the terminal value is going to use the same one as in period 5. So we divide this over here also by the 1.4788. So that's how we come up with the present value of the future projected cash flows. And then the final step, which is quite easy, we go all the way down here to step 7. And by the way, I skipped a little bit of detail here. Divide free cash flow by the discount factors in order to arrive at the present value of free cash flow. So that's what this part is right here. So we're just dividing 61.4 by 1.0814 and so on and so forth. So the last step then is to sum all of those up in order to get the intrinsic value of the business. And if you look on step 7, we now sum all of the present value of free cash flow up and then add to it the present value of the terminal value of the company. And then it's as simple as dividing by shares outstanding. That gives us a intrinsic value of the business today of approximately 1.31 trillion, right? Am I reading that right? 1.31, yes, 1.32 trillion roughly. And we're going to divide that by the 4.334 billion shares outstanding in order to arrive at the intrinsic value of the stock, which is $304.38. So $304.38. Now, we can see that current share price is actually $349.72. So theoretically, this is saying that Apple is a little bit overvalued right now. But that is, very dependent on all of these calculations and all of these assumptions, right? What if we assume that Apple only grows by, say, 3% for each one of these years from 2022 to 2024? What if we assume that the net margins fall or rise, right? So there's a lot of things that can change what will ultimately happen here. And that is the art of discounted cash flow analysis, is figuring out, what the best sort of combination of values is. But that's how you get to an actual share price. So hopefully that's pretty clear. You'll have to probably go back and watch this a couple of times in order to fully understand it, and probably go through a few of these. But that's why I wanted to share the template with you as well, and also the slideshow, so that you can, sort of follow it step by step. Go through this and do it a couple of times, and you'll find that it's not that difficult. The hardest part, honestly, is coming up with the proper projections, because that's the part that we just don't know, right? We're just guessing. So, lastly, I just want to talk about some pitfalls and common adjustments that people, make to this. So when you're calculating discounted cash flow values, when you're calculating the intrinsic value of a stock, one of the key things is how much you're discounting those future cash flows by, right? If we were to change WACC here to only 3%, that's going to drastically change the value of the stock price. Obviously, that's not realistic, right? But it just goes to show you that even adjusting this a tiny bit, even pushing this up to, like, let's say 8.5, really drops the intrinsic value of the stock quite a lot. So you want to really, be realistic about these estimates if you can. And, that's just going to take practice. But it's a lot easier when you have a stock like Apple, where there's, 30 or 40 analysts following it and making projections. It's really difficult to do this when you don't have a lot of projections and you're just kind of guessing. And it's also really difficult to do it on companies that don't have positive free cash flow, or that don't have a realistic ratio here. Like Amazon, for example, their free cash flow to net income ratio is like all over the place. One year it's like 1,200%, and the next year it's minus 200%, and the next year it's 1,000%. So, like, it's really dependent on the company whether this is going to work. So there's a whole bunch of different things that can change. One of them is a discount factor. Another one is that perpetual growth rate, which is subjective, the 2.5% that we put in. That's totally dependent on what you think. Other people will calculate projected revenues and net income and free cash flow differently. Some people don't like to derive net income from margins, for example. So in our case, we took historical net margins and we averaged them together, and then we just assume that those margins are going to remain constant. This might become more believable if we look back 20 years in the past and see that Apple has consistently maintained 20% net margins. But if we don't know that, then another way that we could do it is to take all the expenses out of revenue by, instead of projecting net margins, we project their expenses in order to arrive at net income. So there's a bunch of different ways to do this, and you just have to sort of experiment and find out what works best for you. So I mentioned here longer or shorter projections, or longer historical analysis. So, right, using 10 years into the future as opposed to 5, or using 10 years of historical data as opposed to 4, whatever you think is best. That's another thing people play with a lot. And another thing that people do a lot is using what's called sensitivity analysis, where they will either run multiple discounted cash flow analyses in order to come up with sort of a range of intrinsic values of stocks. So they'll play with, 3 or 4 different possibilities, or 10 different possibilities, in order to arrive at 10 different potential stock prices, and then average them all together. Because the more times you do this, the more realistic it becomes, and the more believable it becomes. So the pitfalls, right, that we've already sort of talked about are that discounted cash flow relies on a lot of assumptions. So it is more of an art than a science. And it's also really time consuming, and it's susceptible to human error in the data entry. So I mentioned earlier that, calculating the present value of terminal value here, I wasn't sure, if we wanted to use the market rate or the weighted average cost of capital in that calculation. So, that's a potential pitfall there. Another potential pitfall is just putting the data in wrong, right? Just putting in the wrong, making a typo and entering in this data. So that's a potential pitfall. There's a lot of spots where this can go wrong. So you have to be careful with it and take it for what it is. One of the things that I do, which I just actually recently started doing, and I don't like working with Excel spreadsheets. I think they're ugly as hell. They work really well, but just building them and working with the formulas and everything, there's only so much you can do. Plus you still have to fill in all of this information. So what I did over the last couple of months was on LazyFA, I actually built a discounted cash flow calculator, which I'm just now launching and looking for feedback on. So this basically follows the same process where you have the WACC estimate here that takes into consideration the cost of debt, the effective tax rate, the CAPM parameters, and then calculates the adjusted WACC based on the different costs that we looked at in this template. So it's basically the same thing. But you can see what I mean by the forecast here with Amazon. This year in 2015, it was 1,250%. And then the next year is 440%. So, using the average here is probably not really realistic. So, maybe what we want to do is change this to, we could add some more data and see, if it looks, maybe 180 something percent or 150% would be more realistic. So if we were to go and change all of these to, 150, and maybe we make some adjustments to revenue growth. We don't think that they're going to grow at 25% or 26% in 2020 because of COVID-19 or whatever, right? So we make this 12.5% and 15, right? Whatever. So the point is that it's a hell of a lot faster to do it this way and to just auto-populate the data with stuff from an API. So once I started learning more how to do this, I got away from the Excel spreadsheets and just decided to do it with Python. And that's one of the other projects that I've been working on in conjunction with the ridiculous thing that we built last week to turn stock prices into sounds. But so this is how you do a discounted cash flow analysis. I hope that that is helpful. And at this point, I'll open it up to questions. So let's see what we got. If you have any questions and you're still watching on Twitch, then feel free to pop those into the chat. And in the meantime, I'm going to look at the Discord channel. And we do have a bunch of questions. Can we see a retracement with ES? That's totally unrelated to discounted cash flow, but possibly. Yeah, I was looking at it earlier. It was at 303 or something like that. So possibly. What's it at right now? I don't know if this is accurate or not, but looks like 305 on ES right now. Yeah, I mean, I don't know. I don't think we're going to see another drop like March because there's so many people that missed the ferocity of this recent rally that, they're waiting for any opportunity to just start buying the dip. So I don't think we're going to see another drop like March, but you never know. Things can change on a dime these days. Next question. When pulling financial data, do you use as originally reported or restated? This is an option on Morningstar. I've been inclined to think the restated data would be better because it'd be more accurate. And yes, you are correct. So the restated data is going to be the most up-to-date. Now, what would be interesting is if you have a company that restates a lot, first of all, that's suspicious to begin with. But Secondly, it'd be interesting to see, run it both ways. Run your discounted cash flow analysis with not only the original data, but also the restated data. And if there's a big discrepancy, then that the data that they restated was significant. So that's a really interesting process to go through. When pulling financial data, you're not looking for trailing 12 months, which would incorporate any financials reported in the latest 10 Qs. As reported on the last 10K. Yeah. So, of course, there are definitely instances where you would want to, incorporate more recent data. This might be a good one. So, in order to do that, what you might try to do is look at what analysts are projecting for the current and next quarter, because this would give you an idea of, what their total 2020 yearly estimate will end up being. But does it really matter? You know what I mean? We have the first and second quarter, we have the last, well, actually, in this case, we only have these 2 quarters projected. So, but we already have the full year projected, current projected revenue. So, I guess if you wanted to, project out the final 2 quarters of the year, then you could do that and try to arrive at a different yearly projection. But yeah, I mean, there's definitely reasons to do that, and this might be a good one. The other thing that you might want to do is break it into different segments, right? So for companies like Apple and Amazon and, companies that have different segments of business, you might want to project your growth based on segments that are growing faster than others or slower than others. And that's where discounted cash flow gets like a little more complicated. So that's one of the things that I'm planning to implement into this also, is the ability to, not only project revenue growth, but also just throw in like arbitrary revenue values, and, update all of these bolded ones with just your own values. I've done it already with the cost of debt. So like, if you can't get the cost of debt quite right, or you just want to arbitrarily put something in there, you can do that. And it won't be right, but then as soon as you update one of these, it just goes back to normal. So I am going to try to add more complexity into this so you can calculate projections differently and, use different methods. But for now, that's what it does. And I'm using Excel for the rest of the stuff. When doing market cap and intrinsic value calcs, are you using fully diluted figures or just issued and outstanding? You probably want to use fully diluted. I only used whatever that first one was here on the 10Q. But, if you want it to be 100% accurate, then yeah, you'd want to use diluted shares outstanding. You always want to account for dilution. With a company like Apple, it's probably not as important. But if you're working with a company that dilutes a lot, it becomes a lot more significant. So the more accuracy you can put into those calculations, the better your valuation is going to be. Yep. So DMW was saying here he might have missed it, but the perpetual growth rate should be very conservative. Any reason you're picking 2.5%? Not really. I mean, so 2.5% is the growth rate of the U.S. economy and the world economy. So it might be less than that at this point, obviously, because of COVID-19. But there's not really any rhyme or reason to why I picked 2.5% tonight. If I was going to seriously consider an investment, I would pick something, with more reason. But this is just to give you an example and to point out that it's arbitrary. Any plans on making your Python tools available? You're talking about the one we made last week, right? That turns stocks into sounds? No. These are available right now, actually. I just launched it. So this one just does Amazon, but I do have it available. It's a paid feature right now, but I don't want to, I don't want to pump that on this. And I did just release it, so I might, make it free for a while as well, but we'll see. All right. Let's see. I think I got all the questions. How are we doing on time here? Man, look at that. 59 minutes and 47 seconds. That was really good timing. I figured this was going to take me a lot longer. Hopefully this is clear. I don't see any questions on Twitch. So I just want to, whoops, I'm creating Inception here. I just want to make sure that there's no questions there. Oh yeah, can I get Discord info? Of course. Server invite link is somewhere here. Whoops. Right there. Oh, forgot I was sharing my screen. Yeah, so you can see it on the chat or on the screen also. But yeah. All right. Well, anything else that I can answer for anyone? Wave, we do these once a week. Usually Sunday evenings at 7 p.m. Eastern. This is the 5th or 6th one in a row. Next week we're doing... I might change this. There didn't seem to be much interest in it. Form 4 filing stream. So I was going to share with people how to read Form 4 filings, which are pretty simple. But, there wasn't too much interest in it. So I'll make another post and see if I can come up with a few more ideas, and we can pick which ones would be most useful. But Form 4s are for insider transactions, so they can be useful in being able to understand those. That's why I wanted to share that with everyone, but there's plenty of other stuff we can talk about as well. All right. Well, thanks, guys. And yeah, Shimona. My Shimona. Anything more Python I'm in for. Yeah, man, that was pretty funny last time. If anyone wants to clone that project, it's github.com/CKZ8780. And the repository is called Stock Sound. This was the completely pointless Python tool that we built last week. Here, I'll pull it up on YouTube, actually. Let's see here. Oh, by the way, if anyone is a day trader, this Humbled Trader, I really like her YouTube channel. She has a lot of really good stuff about analyzing low float stocks and penny stock junk and things like that. So check that out also. I don't know who she is, but she's she's got a lot of good stuff. All right, your channel. So this is what we did last week. I don't know if you'll be able to hear this, but I'll go right to... All right. Okay, so that's what we built last week. We did that live, which was... It was pretty funny. So the point was we wanted to show how to pull in some market data from Quandl, and I just pulled in all the prices and then played them back as frequencies using JavaScript. So you put in a ticker and it pulls in some Quandl data and spits out all the frequencies and makes a ridiculous sound. So, all right. Well, it seems like that is it for this evening. Thanks everyone for tuning in. And if you have any other questions, feel free to tag me in the live chat. You can always email me, info@lazyfa.com or chris@lazyfa.com. Either one will work. Or hit me up on Twitter or Reddit or wherever else. Plenty of places. All right. On that note, I am out of here, and we'll see you guys next time.